You chose the cheaper monthly premium. It felt like a win. But you might have just set a $2,000 trap for your future self. A deductible is the amount you pay out of pocket before insurance covers anything. If it's $500, you pay the first $500. If it's $2,000, you pay the first $2,000. Lower deductible means higher premium. Higher deductible means lower premium. That's the trade. The mistake is choosing the high deductible to save $25 a month without having the cash to back it up. Imagine something happens. A pipe bursts, a car accident, a claim. Now you owe $2,000 immediately. If that money isn't sitting in your emergency fund, you use a credit card. And now you're not paying a $2,000 deductible, you're paying $2,000 plus 24% interest. You paid the insurance company less, only to pay the bank more. That's how the choice costs you twice. If you do have the cash, a higher deductible can be strategic. You absorb the risk. You keep the savings. The rule is simple. Never choose a deductible higher than the cash you could pay tomorrow. Insurance isn't about the lowest monthly bill. It's about making sure a bad afternoon doesn't turn into long-term debt. If this helped, subscribe for more calm, strategic money breakdowns. Next week, we're breaking down how to protect yourself from fraud. Until then, learn here, research more, and then decide for yourself.